Hello everyone, and welcome to Module 7 of Being Your Own Boss, Courageous or Crazy. Today we have an expert that's going to talk to us about the tax implications of the various kinds of business structures that you can set up when you're creating your new company. I'm Carl Dierschow. I'm with Small Fish Business Coaching, and I help people who are setting up new businesses. Leslie Lautzenhiser, as it turns out, was not able to make it today. She had a conflict. She's with Franchise, and she helps people who are looking to purchase a franchise. She helps marry people to the right franchise companies. So let's move right on into it. Linda, why don't you go ahead and advance the slide here.
Okay.
So I'd like to introduce Linda Holdredge. I've actually worked with Linda in the past myself. When I set up my business, she helped me to pick the right structure and to set up the accounting for my business, and was very, very helpful. And so I thought, wow, who better than to come in and talk with all of us today about setting up the right kind of business structure, and because tax implications are a huge, huge part of that. She knows a lot more about it than I do. So, Linda, welcome and thank you, and take it away.
All right. Thank you very much, Carl. Okay, so the first thing I wanted to mention is I'm a CPA. Our office is in Loveland, Colorado. This is the kind of thing we do an awful lot of with clients, and wherever you're located, you probably have CPAs that would do the same thing. The first thing, as always, is the disclaimer, which is basically anything I'm saying is for advice and education. It shouldn't be taken as the absolute right way to do things. You should always consult with your own attorney and or tax professional to discuss your specific situation.
This is what it means to be in a regulated industry, right, Linda?
There you go. And the malpractice coverage covers everything.
There you go.
You know. And if that doesn't, the IRS disclaimers do.
Yeah, okay.
All right. So when you're setting up a business, there's a bunch of things you want to be thinking about. And this is not a complete list, but this is all factors you ought to have answers to when you go in to talk to somebody about what you're going to set up as your business structure and how you're going to utilize that business structure to optimize your new business. Things to consider then. How many owners? Some kinds of business structures have restrictions on the numbers of owners. What are the owners going to do? Are they going to be actively involved in the company, or are they going to be a silent partner? They invest money and that's about it. What should your operating agreement or bylaws have in it that spells out who does what and how income will be split, how the proceeds of the business, if you sell it, will be split? All of those things are spelled out in either an operating agreement or bylaws. State law. Carl and I talked about this a little bit earlier, but for some entities, state law is quite different from one state to another. California in particular has different rules on LLCs, so be sure and check on the state law issues. Articles of organization or incorporation are what you start with to get your company up and running. You'll need a tax ID number, which is issued by the IRS. You need a business bank account, and in order to get a business bank account, you've got to have that tax ID number because that's how the banking world reports their information. You need to consider if personal liability is an issue. Certainly in some professions, medical is the huge one. Personal liability is a huge factor in deciding what you're going to set up. Fringe benefits. By that, what we usually mean is retirement plans, health insurance, company car, any of those kinds of things. How are they going to be structured, and what are the tax implications of those? And exit plan. You set up your new business, you have a great idea. How's it going to end up when you sell it? How's it going to end up if you and your business partner decide you no longer get along? How's it going to end up if your business partner is your spouse and you and your spouse get a divorce? All of those things are things that it's important to think about up front so that you can structure it in the manner that's the most helpful. what services or products will your business offer? It's not at all uncommon to have a business start with a big mix of things and end up whittling it down to one or two things. And then the last item on the list, what's the business purpose of the entity? Why are you setting up that entity? Is it for liability purposes, tax purposes, some of both of those? Is it to help you organize in the most effective manner? All of those are things that you need to be thinking about when you go in to talk about how you're going to set up your business.
So, Linda, this raises a whole bunch of questions if you want to go back to that
Sure.
previous slide. So, in my experience, so I'm basically a one-person LLC, and
Okay.
I am a franchisee of Small Fish Business Coaching, but
Right.
my legal structure actually is a different name, and tax ID number and all that kind of stuff. So I've got a relatively simple situation from that point of view. When I did this work with you, a lot of these things listed here were pretty simple and straightforward. The operating an agreement and bylaws, I was surprised, but when I went onto the State of Colorado website, that ended up being like just a few sentences, if I remember correctly. It was no big deal, but I would imagine if you're talking about a partnership or a larger structure, then that can get to be quite extensive.
Well, and I would agree. And you can, in Colorado, and I don't know about other states, you can set up your own corporation or LLC at the Secretary of State's website. What we always encourage people to do is, especially if there's more than one individual that owns the company, to sit down with an attorney and talk about an operating agreement or bylaws. An operating agreement is going to be how an LLC or a partnership runs, and bylaws are how a corporation runs. But we suggest you sit down and talk about it with an attorney, because they're going to help you figure out some of the things that otherwise you might not think about, that you either need to do regularly to keep your company acting like a company, or that you need to set up so that if the company is going to be sold or split up, you've got the pieces in place.
Okay.
So for a single purpose, a single member company, it's not always as important, but if you've got more than one person, I think those are issues that you need to be addressing, and sooner rather than later is always a good idea.
Yeah, I totally agree. I've seen so many businesses that have run into problems because they didn't address these things earlier, and then later on the business, when one of the partners decides they want to sell or exit somehow, or the goals diverge a little bit, it can get to be really messy, and you can end up in court and spend a massive amount of money resolving something that could have been a simple discussion back when you formed the company.
Well, I've been peripherally involved in a court case recently where two owners of a company who are married to each other are splitting,
Mm-hmm.
and the value of the business is estimated to have dropped by half, from something that was well into the millions to half of that in a period of 6 months.
Oh my, yeah.
Because they haven't been able to figure out how they're going to split it, and their client base is all going, hey, I don't know if you guys are going to be around, I'm out of here.
So should I talk to an accountant first or a lawyer first, or does it not matter because I'm going to have multiple discussions with both?
I would say either one.
Okay.
And then I would also say make sure that they talk to each other. I had an attorney tell me the other day that he's very specific on putting things in the operating agreements about how he expects things to run, and that frequently the CPAs do not either read that or follow that. So I think if you can have the conversation between the professionals up front, it makes it a cleaner, neater process.
That's a good idea, actually. And now you did mention something about California. Both you and I are located in Colorado, and so we've got our own particular state regulations and all that, and even local regulations. what would you recommend for, most of our listeners are outside Colorado, so what would you recommend for people that are in other states or even other countries?
Other countries, I think it becomes then an issue of, are you doing business in the U.S. or doing business in your country, and then checking in with the proper legal people. I know someone here that I do business with had previously had a business in Germany, and the rules are totally different.
Yeah, I would totally expect that. But
so
starting
then,
off with your lawyer and your accountant and maybe your confessor, I don't know.
yeah, right.
Too.
I think I think it just depends where you start, is attorney or accountant, and then I think make sure that they're familiar with the rules for the jurisdiction you're going to be operating in, and then I think it's really helpful to encourage them to at least touch base with each other and make sure that they are in agreement on a way for you to proceed.
Okay. All right, excellent. And the same logic holds for other states as well, that one of the things I found useful was to go to the Colorado Secretary of State website, because they actually have a surprising amount of information.
And more states have stuff on either their Secretary of State or Attorney General's different websites in different states. And I think that's an excellent place to start. And most states anymore have some sort of you want to start a business in our state, here's what you need to do.
Mm-hmm.
And I think that's a great place to start. But there's nothing better than talking to somebody that operates in the field, so to speak, and they go, oh yeah, well that's what it says, and this is what that means that you need to do.
Yeah, I mean that's totally why I was working with you, because you can read the website all you want to, but trying to interpret it as to, well, then what would be the best for me, and what do all of these complicated technical words actually mean in real language? They're not in the business of giving you specific advice for your situation. They want to say, here's the legal framework in this state, and that's as far as they carry it.
Well, and I think the other thing is that going outside of what we're talking about specifically, but say something like collecting sales tax, the state or the local jurisdiction is in the business of collecting sales tax. If there's any kind of a gray area, they're going to say, yeah, you need to do that.
Right.
Whereas somebody that's in the arena may have an idea that says, oh, well, yeah, if you structure it this way, then that's no longer an issue. And so I think that's the other reason to get a professional involved. And that said, I know a lot of business owners who have set up their own and there's never been a problem. And I think the biggest reason to get professional advice is exit strategy, and if you have more than one owner, you want to make sure that how the business is going to operate and dissolve and sell are all spelled out up front.
Excellent. Okay, well, why don't you walk us through some of the examples of the different kinds of structures that we might set up as a company?
Okay. So the first and the easiest is a sole proprietor, which is a Schedule C on a Form 1040. It doesn't take anything at all to set this up. You can go set up your lemonade stand on the side of the road and be a Schedule C on a 1040 in the U.S. All the income and expenses are reported on the Schedule C. The net income is subject to self-employment tax, also subject to federal income tax, and if you're in a state with a state income, it's subject to state income tax. The owner of the business is liable for all business debts and actions. It's the easiest thing to set up. It doesn't require anything except in some jurisdictions you may need to register trade names or get sales tax licenses, those kinds of things. And again, those are reasons to go talk to someone that operates in your jurisdiction to make sure that you know all those little things you need to be doing.
Right.
The next choice is a single member LLC, which I I believe, Carl, is what you're operating as.
Yeah.
And a single member LLC is, for tax purposes, disregarded and treated just like a Schedule C. It's set up the LLC is set up at the state level, but for income tax purposes, it files a Schedule C on a Form 1040. The owner of the business is going to report the net income and pay self-employment tax on the net income on their 1040. So for federal tax purposes, and the states follow along, it's disregarded as a separate legal entity. In most states, a single member LLC has some liability protection.
Mm-hmm.
And that's why that's why an individual would set up an LLC, is to try and get some liability protection. That is something you should definitely consult with an attorney in your specific state. In Colorado, there have been a few, call it, forays into single-member LLCs by the bankruptcy court. The attorneys that I work with are generally pretty adamant that the statute is clear. The single-member LLC should have liability protection. However, there is some concern that in Colorado it's been slightly eroded, and so that's a reason that you always want to get an attorney involved in that discussion if liability is a huge factor in your decision.
Yeah, I guess when I was doing my research, I saw that there was some instability around if the court would decide that you as a person were like fraudulent or something like that, that then they could go after your personal resources. I suppose kind of similar to if you worked for a multi-person company, but you as a person were doing fraudulent things, that being able to hide behind your company and say, well, it's the company's fault, not mine, that they might look at that skeptically. But
and I think that's an area that, because LLCs are a relatively new legal entity, they were first started in Wyoming in the early 1990s. Because that's a relatively short time in the court world, and the way the legal system works in the U.S., some of the operating parameters are going to be established by court cases, and there haven't been as many as there have been for other legal entities. So it's going to be an evolving area, and different states have very different rules. And California, as we mentioned earlier, has some very specific rules, and one of those is a yearly fee to maintain a single-member LLC, and it's substantial enough that people I know in California say it's really not worth the extra cost. So again, that's a reason to check with someone that's familiar with the legal issues in your particular area.
Okay. And here's a good question comes up. I know this threw me off, that word disregarded. When I first started out, it's like, what exactly does disregarded mean and talk to? And I figured out that it basically means when you're filing your taxes, you just submit all your stuff on a Schedule C like you would normally, and that's cool. And so you don't have to do a whole ton of extra tax paperwork regarding that, but you get the benefits of being an independent company, the liability protection, the separate named entity, things like that. And so it ended up being a lot less scary, but when I first saw that word, it kind of threw me off a little bit.
Well, and I have to agree that's probably an unfortunate word, but somebody at the either congressional or IRS level decided that was the appropriate thing, which is basically it's disregarded as a separate tax return from its owner. So it doesn't file a partnership or a corporation tax return. It files a small business tax schedule on the owner's 1040.
Right. And which ends up being surprisingly simple if you keep good accounting records. So.
Yeah,
All
and,
right.
and that's probably a whole nother topic sometime about good accounting records.
Yeah, okay, that takes up its own series. So, all right, so you got some other forms here. Let's have a look at that.
Okay. All right, so then a partnership files a separate tax form. The form is a Form 1065. A partnership form is filed by an LLC, a limited liability partnership, which is an LLP, or an LLLP, limited liability, limited partnership, when there are two or more owners. If the two owners are a husband and wife, that's definitely a situation where you want to sit down and talk with an accountant about the options, because that's an area that's recently undergone some changes, and I would expect those changes could continue. Tax implications of a partnership are, it is a flow-through entity, and what that means is, except in very rare situations, the partnership doesn't pay any income tax. The partnership return is what we call an informational return. It shows the income and expenses. It shows how those are allocated to the respective partners, and then it generates a Schedule K-1, which is what each individual partner gets to show their share of the income and expenses. That K-1 information is then put on the individual partner's 1040. But it's not a Schedule C, as we just discussed in a single-member LLC. It goes instead on Schedule E in a summarized form. So the
So does the
partnership,
partnership file an independent return of its own?
yeah,
Oh,
it
okay.
files Form 1065, and the partners in the partnership can't file their 1040s until the partnership return is done and they have their K-1 showing their share of the partnership income and expenses. Within a partnership, it's important to set up your management, to agree on your management structure. Who's going to run the partnership, who does the day-to-day decision making, and recognize that some of those decisions can have tax implications for one or more of the partners. And that's an item that is beyond the scope of today's discussion, but it's important that anyone in a partnership be aware of that as a possible area of concern and be comfortable with the decisions that are made. A partnership also allows for a variety of allocation options, and what I mean by that is, if it were if the partnership wanted to do it for a specific reason, they could allocate income to one partner and a different proportion of expenses to a different partner. All of that requires serious tracking, which is what the accounting system needs to do. Partnerships also get used a lot, say in a land kind of deal, where somebody might bring land to the table, somebody else is going to develop the land, and somebody else is going to build the houses on the land. Those are the kinds of things that you might get different allocations of different items of income and expense. When you're getting into that level of stuff, you need to have, it's very clear, you need to have your accountant and your attorney actively involved in making sure all the parts come out the way you expect them to come out, and that everybody's comfortable with that.
So is that what you're using in your structure, Linda? I don't know if I'd ever asked you that before, but you've got
in my business?
Yeah.
No, actually we're not. We're an S corporation, so we'll talk
okay.
about that the last.
Okay.
But partnerships, the other reason people need to be utilizing partnerships is sometimes because they have, like a corporation is going to be one of the partners, or if you have someone from outside the U.S. is going to be one of the partners. Those are all reasons that sometimes you've got to step in and have a partnership because some of the other entities don't work as well.
Okay.
So a partnership, or an LLC choosing to be taxed as a partnership, has probably got the infinite flexibility, but not surprisingly, with infinite flexibility comes the potential for infinite problems if it's not set up front and discussed up front. Because one of the things that happens is you get 10 guys together and they're all like, oh yeah, well of course this is how it's going to be, but it turns out that 5 of them thought it was one way and 4 of them thought a different way, and so.
Well, but that just reflects the complexity of doing a partnership in general. I mean, no matter what your structure is, when you have 2 or 3 or more people running a company and expecting a return from it, there's plenty of chances for misset expectations and unclear communications.
And I think that is a huge, huge factor in a successful business. And something an attorney I work with regularly uses as a phrase all the time is there is trust between the partners. And I think that's important as well. And even though there's trust up front, that doesn't mean that you rely totally on trust.
Mm-hmm.
The trust is that you're going to get it all worked out, and then the nitty-gritty is what you do to get your operating agreement that spells out the details.
Okay.
So.
All right, cool. So let's talk about C corporation. I'm interested in this.
Okay. A C corporation is the most restrictive, if you will, type of business entity. You set up your corporation at the state level. C corporations can be everything from a mom and pop corporation to IBM, General Motors, HP, all of those are C corporations. C corporations have stockholders. They can have unlimited numbers of stockholders. They can have multiple kinds of stock. They can have preferred stock. They can have voting and non-voting stock. A C corporation is a separate legal entity, and it's the only one of the ones that we're going to talk about that pays tax itself. So if a C corporation makes money, it pays tax on the profits. If a distribution of profits is made from a C corporation to an owner, it's a dividend. The dividend is not an expense of the corporation. It's not deducted. It's paid with after-tax dollars, and it's going to be taxable to the owners. So when you look at C corporations, you almost always see a discussion of the fact that it's got double taxation. Mm-hmm. For a small business that's set up as a C corporation, effectively there's going to be 2 ways to get money out of that corporation to use personally. One is if you pay yourself a wage because you're working in the corporation, and 2 is the idea of a taxable dividend. A C corporation is attractive sometimes because you can do a little bit more with health insurance and fringe benefits. And it's clearly got the ability to have a variety of types of owners. So sometimes you could have a partnership as an owner, you could have other corporations as owners if that's important to you. Most of the time, I don't see small businesses set up a C corporation. It's the least flexible of the entity, and for a small business, they usually don't want to have the double taxation issues. So I would say that would be my last choice for a legal entity for a small business, and especially one that's just starting out.
Well,
however,
there's just so much overhead with running this. If you're a small company, I would think that the overhead can eat you alive.
Yeah,
large companies
and
doing
I don't think you get much benefit until you're big. Now, if you were going to be big enough that you're publicly traded, you have no choice. But you know, for most small businesses, you got a year or 2 to get to the publicly traded option.
So if I'm say a single person or a small business right now, but I have great ambitions to grow huge, in 5 or 10 years or whatever, is it hard to start at one of these models and then move up to a larger one, and 10 years from now, then I'm a C corporation?
Right. I'd say that's a great question. And what I always tell people is the easiest and most flexible thing, assuming that there aren't any roadblocks due to ownership or whatever, types of owners, anything like that, is to set up an LLC. From an LLC, you can always make a choice to go to a corporation. You can also dissolve the LLC and take the assets and put them in a corporation with relatively little tax consequence. If you start with a corporation and then want to go down or back, if you will, to an LLC, there's potential tax consequences, potentially bad tax consequences. So I always suggest let's start with an LLC or possibly an S corporation, which we still haven't talked about. You can always move up to the more restrictive C corporation kind of thing, but moving down is not as easy. And when you're starting out, leave yourself the most options and the most flexibility. As you grow and your company's really going to take off, then you're going to have the ability to work those other choices into the system without having limited yourself in the early days.
Okay. So let's talk about the S corporation, see where that fits in.
Okay. So an S corporation is a special kind of a corporation. You set up your standard corporation at the state level. Then at the federal level, you make an election to be taxed as a subchapter S corporation. You can also make an S election if you've set up an LLC. In either case, the election is made at the federal level on Form 2553. Timing on that form is critical, and there's some oops, please forgive me, I didn't quite get it done right options, but I know I'm currently working with a corporation that thought they were an S, they had made an S election and they have not, and it doesn't look like any of the please forgive me provisions are going to pan out, so they're kind of toasted here. An S corporation is sort of a hybrid company. You set up the corporation, you have the legal implications of being a corporation. However, it's designed to be specifically used for small businesses. You can only have 100 shareholders, and the corporation files a separate tax form, Form 1120S, that reports all the income and the expenses. However, it doesn't pay tax. Unlike the C corporation, the S corporation is more like a partnership in that the net income and expenses are flow-through. There's a K-1 generated from the Form 1120S that shows each owner's portion of the income and expenses. Again, 1040 for the individual owner can't be prepared until the K-1 from the S corporation is done. The thing that's different about an S corporation from a partnership is everything in an S corporation has to be done in proportion to ownership. So if you've got a 10% owner, that owner gets 10% of the net income of the S corporation. There can't be a separate agreement to pay some of the income differently and some of the expenses differently, and if that's something that's important, that kind of entity has to be an LLC then, or a partnership. An LLC tax is a partnership. In both the partnership and the S corporation, we regularly run into owners who think that because they didn't get any dollars in their pocket from the entity, that it didn't make money and they don't have tax. And that's not correct. It's not out of the question that the business reinvested all of the excess cash into growing the business, but it still made money. And so you may be paying tax on money that you didn't receive. And that's always a struggle for a business owner to understand. But I didn't get anything and I have to pay all this tax.
Yeah, so you better plan that up front and know exactly what you're doing. Yeah.
Right, and I work with a medical practice that's paying off a lot of debt, and so the bank has a restriction on them paying out any profits. The bank says you can't pay any profits until you pay us. And so every year they ask the bank for permission to pay enough to cover the tax bill on the income. So they're going to get, say their share of the income is $20,000 and the tax on that's $3,000, they're going to get $3,000 to cover the tax, but they're still paying tax on the 20. When they get the bank paid off, then they'll be okay. But the bank has, in order to provide the loan, the bank puts some restrictions on, you can't pay this money out.
Oh, okay.
So that's an ongoing issue for any kind of a company that's going to have a lot of debt. Is you may not have a lot of cash available because your cash is going to pay off debt, or alternatively a manufacturing type company where your cash is going to buy equipment and stuff. In an S corporation, if the owners of the corporation work in the corporation, there are some requirements that the owner has to be paid a reasonable wage for the work that they do. So this is always something that needs to be discussed with both the attorney and the accountant. What is a reasonable wage for the work that you do? And then you need to run payroll. There needs to be a W-2, there need to be payroll reports, federal tax deposits, which are a deposit of the payroll withholding into the tax system. All of those things are requirements for an S corporation, and they aren't there for an LLC being taxed as a partnership. And sometimes that's a factor for owners. They don't want to deal with payroll, they don't want to deal with tax deposits, they prefer to be a partnership. So those are all factors to be discussed with the attorneys and the accountants to make sure that you're comfortable with the day-to-day paperwork that will be required to keep your company going.
So, Linda, my perception, not being too deep into this, is that you have to tell the federal government which of these models you're using, just so they know how to make sense of the returns that you're sending in and stuff like that. But the things like the LLCs and maybe the LLPs, those are much more attached with your declaration with your particular state. And with LLCs especially, there's a fair bit of variance from state to state. Of course, C corporations and maybe S corporations are going to be pretty standardized because those are intended for larger companies that are in multiple states and everything. Is that right?
Well, I would say you're right, with the only other thing I would add is that C corporations and S corporations are more standardized, partly because they've been around a lot longer. So there's a lot more case law.
Yeah, okay. Yeah, that makes sense.
S corporations were established by federal tax law in the mid-1950s. So we're going on 60, 70 years of history with those. And prior to LLCs, partnerships were highly, there were many partnerships and there was a lot of case law, but a partnership is a plain partnership is very rare now because most states have set up LLCs in such a manner that individuals prefer an LLC because it gives them more liability protection than a general partnership. So we've got this situation where an LLC is out there, it's a relatively new entity, it's taxed kind of like the old-fashioned partnership, but it's got some differences, and so that's why we're still going to have variations between states, as well as just interpretation within the court system is still working its way through. A number of states use the Uniform Partnership Agreement in some or all of its form, so that if there isn't a partnership agreement or an operating agreement set up, it defaults to that Uniform Partnership Agreement, but that's not accepted by all 50 states. So,
okay. Well, I do need to be sensitive to people's time here, so why don't we get to the wrap-up slide here?
okay. So, in summary, different business entities are appropriate in different situations, and I think to pick the entity that is appropriate for your situation, it's critical to outline your situation, what your business purpose is, who the owners are going to be, and what your long-range goals are, including what's your exit strategy, both from the business and from any other owners, that any other business partners, whether you're married or not married. You're married is a business, even if you're not married to each other individually. I would say it's important to consult with a business attorney and a tax advisor that has business expertise to determine the optimal entity for your new business, and recognize that you might set something up and that it could change as your business grows or changes.
Well, fantastic, Linda. Thank you so much. And I did want to bring up one thing that I heard recently. There was somebody that was saying that, well, you know, LLCs might not be worth the trouble to set up because, you know, only think about doing that if you're envisioning a company that's going to be like $30,000 or more in yearly income. And I was thinking, holy cow, you know, I set up an LLC by default just for the protection value that it would give me. And I think the difference was because he was in California and it was much, much more expensive to set up an LLC than it is here in Colorado. So, you know, I'd recommend people really do look into that. There are differences between the states. What you're hearing here may have some particular tweaks for the situation that you're in.
And I would agree with that, Carl, that it's important to find out what is the best option for where you are. And the other thing I would encourage people to do is, you know, talk to an attorney and accountant. If you don't feel like you understood the answers or that they're listening to what you want, shop around.
Oh yeah, it's not like there's a shortage. So.
That's right.
So, okay, well, let's go to the last slide, Linda. Thank you so much, everybody. I do appreciate you showing up. And like I said, Leslie sends her regards and regrets. She couldn't be here today, but she is a franchisee with FranChoice. They help people who are looking to pick the right franchise to meet their personal and business goals. I am with Small Fish Business Coaching. I help business owners who are looking to grow successful and thriving businesses. So thank you, Linda. Thanks so much. And thanks everybody who's been here today. We will see you on Module 8, which will be coming up shortly. Thanks a bunch. Take care.